Thank you. Thank you. So, what I'm going to start the evening off by is providing some context really around some of the technology challenges for OTC derivatives. I mean, obviously, I think many people have encountered me before and know of my work on XVA. So it will come as no great surprise that XVA is going to form a considerable part of what I'm going to talk about this evening. I think I am going to talk more broadly than that, and I also point out that there's not that many slides in this presentation, which is perhaps a little bit unusual for me, and there are no equations, which is also quite unusual for me. But I am going to talk about some of the technical challenges that you come across, and in many ways, as I said to somebody slightly just before the presentation kicked off, actually this is quite close to the day job, and a lot of what we talk about at conferences is not necessarily really the day job. We talk about high-level things about XVAs and how we define XVAs, but actually the real craft of what you do in an XVA role is actually a lot to do with building models and building systems and understanding how to make them go fast, and what the real issues are about making them go fast, and where you can take shortcuts and where you can't. And that's really in some sense the art of XVA, and it is quite critical. And as you'll see, that the need for speed is really very important, and it's not going to go away. And as you'll see during this presentation, it's going to get worse rather than better, and the need for technological improvement and enhancement is only going to grow. Now, before we get into the kind of the nitty-gritty, I have to kind of start with the disclaimers, just to note that the opinions expressed in the presentation are those of myself, the author, and do not represent the views or opinions of my current employer or any previous employers. I also have to note that Chatham House rules apply to the reporting of the presentation. So that means if there are any members of the press in the audience and you do want to quote me or anything like that, then please contact me and contact my media department, and they will be able to advise you. I also need to point out that there's a big disclaimer on the back of this presentation, and I'd also draw your attention to that as well. So, what are we going to talk about tonight? Well, it's going to be relatively short, but I'll try and talk to the points in a lot more detail than perhaps are presented in bullets. But three key points, really: implementing regulatory change, XVA measurement, and more broadly, automation and intelligent systems, which is something I haven't really previously spoken about, but it's something which is interesting and I see as a market development, and I'll talk to that at the end. But I think obviously that the top two there, they kind of overlap, because XVA measurement actually feeds into regulatory change, as we'll see. So the two are quite closely related. So implementing regulatory change. What's coming? So FRTB is the first topic, really. So in terms of technical challenges and performance challenges, the big one is FRTB. FRTB IMA is obviously going to replace. So this is just the basic framework. So under FRTB, there's quite a lot goes into FRTB, fundamental review of the trading. It's been a big change. It's been coming over the last 3 years or so in various iterations. We've seen various changes from the regulator to change the market risk framework for regulation. So this basically replaces in total the Basel 2.5 framework for market risk. There are several components to it. There's a lot of work on the boundary between the trading book and the banking book. That doesn't necessarily have any technology implications. It has a lot of implications for banks and how they treat and the capital treatment for derivatives in particular, which are more likely under the new regime to fall into trading book than perhaps previously they would have done. But it also replaces the market risk methodology with two things. One is it replaces the internal model method, the IMM method, with what's now they're called internal model approach, or IMA, and it replaces the previous VAR and SVAR framework with expected shortfall, or ES, short. It also brings in a large change in terms of the standardized approaches, which is completely replaced by a new standardized approach, which is based on sensitivities, SBA, FRTB, SBA is how you see that presented. Now, that in itself doesn't necessarily have technology challenges in terms of performance, but it certainly does have some challenges in terms of implementation, because everybody has to implement that. Right? So whether you're IMA approved or INM approved, you're still going to have to do standardized, and everybody has to do that and publish it on a monthly basis and publish it as part of your accounting. And the regulator is also likely to introduce a floor that's going to be based on the standardized approach, sensitivity-based approach, which will be some percentage, so to kind of some percentage of the floor, so you don't get absolutely potentially all the benefit that you could do under internal modeling approaches. But internal modeling approaches are really where the performance challenge comes in. And you might say, well, okay, so expected shortfall, what is expected shortfall and how does it differ from VAR as a method? Basically, if you think about VAR, the classic way to explore what does VAR mean, how do we calculate VAR? So if we do a Monte Carlo simulation or a historical simulation approach, typically what you do for HISTIM is you take some shocks, however many of those shocks may be. See, if you had a year of time series of historical shocks, that might give you 250 shocks to apply. You then take today's market data values, you apply a historical shock. That historical shock may be defined in relative terms or absolute terms, or with some volatility scaling and other factors that drive how you generate the scenario. You take that historical shock, you apply it to today's scenario, to today's market data, and that gives you a market data scenario. And then you revalue all of your trades that fall into scope of the calculation, and you do it for all of those scenarios. Now, if you're using a VAR methodology, then what you do is you look for a percentile of those corresponding to a scenario in terms of when you've lined them all up in a big row and take the worst, and then you come in by X percentage points, and then that gives you the VAR level. And it also, SVAR is just VAR, but where you take a different approach to generating the scenario. So for VAR, what you do is you typically look at the last year's worth of data, whereas SVAR is a stress calibration where you've taken a specific stressed period for the calibration. Now all that's getting replaced with expected shortfall with a stress calibration. So an expected shortfall, what it does is it says instead of taking a few percentage points in, it takes the same percentage point in, or a percentile level in, and then looks at all of the scenarios outside that percentile and averages them. So in fact, from a methodology point of view and from an implementation point of view, you still have to do the scenarios, so it's still the same computational count, and it's just that you take an average rather than you take a single point. Okay. So the same underlying methodology can be used: historical simulation, Monte Carlo. The valuation can be full revaluation, it can be grid revaluation, etc., etc. So nothing really changed. However, whereas today you would have to calculate a VAR and an SVAR, the methodology in its detailed implementation actually requires you to do lots and lots and lots of expected shortfall calculations on a daily basis. And some estimates have come up with around 63 different expected shortfall calculations, whereas previously you might have only had 2. So that's a really significant uplift in the number of scenarios that you'd have to generate. Obviously, the computational implications depend on the details of the methodology that you actually use and get up in an INO approved. But that's obviously, potentially at least, a very significant uplift in calculation cost. So that's one challenge. Let's talk about another. Let's talk about FRTB, CVA. So, okay. So, as you might be aware, the CVA methodology was introduced under Basel III. So, capital became associated with CVA under Basel III, and it came in because of regulatory reflection or understanding that actually a lot of the losses that were seen during the crisis period of 2007 to 2009 came through CVA losses rather than necessarily realized defaults. So that's what motivated the Basel Committee to introduce CVA methodology. And that CVA methodology came in two flavors. You could use the basic method. Everybody could use the basic methodology or the standardized approach. And the standardized approach is a formula-based approach where you take the current exposure method numbers or the EAD that you take from your existing CCR calculation, counterparty credit risk calculation, and you plug those numbers into a formula at book level and you calculate it. So computationally that's not a big challenge, but the standardized approach could also be complemented by the advanced approach, and you have to have the required sets of regulatory approvals to do that. So you have to have specific interest rate VAR risk, so that you can calculate, you are approved to calculate under IMM the VAR methodology, VAR for the credit spreads, and secondly that you have IMM approval for your counterparty credit risk engine, your exposure engine, which you use to calculate your CCR, but you apply that to generate the expected exposures that you use to feed in to a regulatory CVA calculation that is broadly similar to universal CVA. And then, so basically you have to calculate the VAR on your CVA. Now, okay, that's reasonably challenging if you do it by full evaluation, but if you don't use it, if you didn't use full evaluation, then actually use a different approach, then it's reasonably similar to some of the calculations you already have to do in the bank. The difference is that it's not really very like CVA from an economic point of view. It's a regulatory number. It's driven by the CCR engine, which is typically not the engine that you'd use for your CVA, economic CVA calculation. The CCR calculation is typically a P-measure calculation, whereas the CVA is typically a risk-neutral calculation. So these are, quite often they're done using different engines. CVA is calculated using the front office engine, CCR is calculated using the risk engine provided and maintained by the risk department. So all of that changes under FRTB CVA, and it's very likely that it's going to move over to the economic CVA, which is something that the market has been very keen to do since day one, really, because actually CVA is seen really as a market risk element. It has elements of credit risk and counterparty risk, but it's really the market cost of that counterparty risk. It has market risk sensitivities and it has credit risk sensitivities. And actually CVA trading desks are engaged in the risk management of market risk and market risk sensitivities and credit risk sensitivities. So FRTB aligns FRTB CVA under the IMA approach, under the SVA approach, is a lot closer to the market risk elements of FRTB. Now, when it came in, there were three methodologies. There were three methodologies. There was the internal model approach, the sensitivity-based approach, and as a basic approach, which bore some degree of similarity with the existing standardized approach. With further reflection, the IMA CVA element has been removed from the document and by subsequent paper. Now, what that approach was, that was based another expected shortfall approach, which would have been potentially, at least, very computationally expensive to. It would have required under a full revaluation approach. It's slightly less than it's an expected shortfall methodology. It's similar to the FRTB IMA approach. It required only 7 expected shortfall calculations to be done as part of the framework. And you would have been required to calculate that daily. Now, in practice, you wouldn't have had to calculate all 7 for every netting set, because actually a lot of netting sets would not have had contributions from certain asset classes. So a good ballpark figure was 4 expected shortfalls. Based on a year's time series, that gives you 1,000 scenarios on a daily basis. So if you do that with full evaluation as opposed to some other approach, like a delta gamma vega type approach, then potentially that's 1,000 revaluations of your CVA. Now, obviously that's a lot. Don't know if that was a factor in the decision by the committee. There was expressed concern in the initial document about whether CVA could be modeled internally from a regulatory perspective, and it may simply be that the regulators, Basel III committees, have made a decision that actually they don't want internal models in the space, or not to the same extent. So where we are now is we have basic and we have the sensitivity-based approach, and the SBA CVA is very similar to the FRTB SBA approach, although somewhat cut down. Nevertheless, it still requires quite a large number of sensitivities to be calculated and fed into the calculation. So itself, it is, still reasonably computation intensive, although nothing like as computation intensive as the original IMA approach. Okay, so let's kind of go through the list now. What else have we got? Well, stress testing. Stress testing is a big part of regulatory activity, regulatory interest, internal interest, etc. Stress testing applies to everything. It applies to the regular valuations in the book. It also applies to XVA. Where does it come in? So in US regulations under Dodd-Frank, you have DFAST and you have the CCAR framework, which sits alongside it. So these two kind of go together as the regulatory stress testing frameworks for the US. It's a big deal. It's a big focus for risk departments for US regulated institutions, US banks. But even outside that framework, you have a number of in Europe, you have European-wide stress test exercises on a regular basis. You have local regulator stress tests on a regular basis. You have internal management stress testing on a regular basis. So having a stress testing framework is something that every bank has to have. And there's increasing focus by regulators. So regulators wanting to look at, for example, CVA stress tests as part of that. Now, XVAs, that's a big deal from that computationally expensive calculation that we'll see in the next section. And again, so what you're asking banks to do is to do stress testing on XVA. The difference between this and previous approaches is stress testing, you really can't avoid the kind of shift and reval, because that's really what is being desired here, is ultimately you want to know, under the stress scenario, what is the value of the book, what is the value of the XVA. So potentially very computationally demanding. Okay, so that's really the regulation section. So let me move on to kind of what I do as a day job with XVA calculations, and let's have a little look at why XVA in particular is a real computational challenge. So basically, while there are alternative models, the traditional approach to XVA calculation is Monte Carlo based. Right? It's a big Monte Carlo, and what you have to do in that big Monte Carlo is you have to run a large-scale Monte Carlo simulation. You have to then value every trade within your derivative portfolio on a large number of time steps between today and the maturity of that portfolio. And you have to use a large number of Monte Carlo paths to get the models to converge properly. Now, yes, there are various reduction of schemes, and most banks and systems use them to some degree or another. But you really don't have much of a choice here, because actually the problem, why use Monte Carlo for XVA? The key drivers really are two things. One is the high dimensionality of the calculation. XVA netting set is a netting set with a bank. So say you're counterparty netting, you have a netting set with a counterparty. That netting set, to take advantage of netting as a risk reducing, as a credit risk reducing factor, you need to simulate all of the asset classes and all of the trades that go into a netting set at one time. Can't really escape that. And the problem is that because typical netting set can have anything in it, it could have multiple currencies, multiple interest rate products, commodities, equities, you name it, it could be in the same netting set, particularly for larger interbank positions. So very high dimensionality, and really when it comes to computational numerical methods for finance, as soon as you get above a dimension of 4, then really the only game in town is Monte Carlo. Now, Monte Carlo is slow, but it actually will outperform any other methodology when the number of dimensions is bigger than 4. So and that's been proved. So actually, Monte Carlo is the best you can do, but nevertheless, it's still a slow approach. The other factor, though, is that not just high dimensionality, is that a Monte Carlo actually gives you a high degree of flexibility in terms of asset class and trade coverage. So it's something that gives you a degree of flexibility, and you need flexibility in the systems because you can be faced with anything. Basically, your trading desk could come up with anything. A new product can flow down into your system very quickly, and you need the flexibility to be able to cope with a very wide asset class and trade coverage. So it's computation intensive. Okay, so is there anything else that you can do? Well, there are alternatives, right? But those alternatives tend to be they may be based on probability methodologies coupled with Monte Carlo. That's an alternative approach. They may be based on more sort of grid-based approaches to doing the calculation, but they tend to have restrictions on them in terms of the methodology, in terms of the choice of dynamics, etc., etc. So Monte Carlo gives you a great degree of flexibility in terms of what you can actually implement. So the other thing is the other problem they potentially face here, which can make even more computation demanding, is it's okay if you have to simulate a netting set potentially, because even the biggest netting sets will only have a limited number of asset classes in them. Potentially though, some calculations, such as the Albanese-Anderson FEA model, are set explicitly at portfolio level. Now, even if you don't want to choose that method for FEA, there are certain elements of the capital framework, such as leverage ratio, which are at balance sheet level. So if you wanted to do a KVA calculation, however you wanted to do that, whatever methodology you chose to do that, it's still a number that requires you to calculate a portfolio level computation. So a portfolio level computation of XVA is one step further on in terms of complexity, in terms of computational demands to do it. Now, obviously, there are various approaches and methodologies for dealing with that complexity, but nevertheless, it's something which is computationally potentially very expensive. And then, what do we actually do with the XVA calculation? Well, it's not just about running a Monte Carlo simulation. It's about running and risk managing a book, and that risk management requires sensitivity calculations. The issue there is that it's not just as a consequence of that high dimensionality, as a consequence of the broad asset classes that go into it, it's basically everything in the derivative book. You have not just, you have potentially hundreds to thousands of shift and revalue if you did this by finite difference. So if you use a finite difference approach, just think about this, just two sensitivities, just an example here. So interest rate risk plus tenor basis. Right? So your typical yield curve, your basic yield curve will have maybe 30 instruments in it. Any time you've added your primary curve build may have 30 instruments coming from money market instruments, futures, swaps, out to 50 years in some cases. So that can give you 30 instruments. Then in a multi-curve environment, which is typically where we are today as an industry, then you've potentially got a whole series of overnight, anything from your overnight OIS swaps. You'll have tenor basis swaps, and potentially for multi-currency environment, you have cross-currency basis feeding in as well. So by the time you've added all of those instruments in there, you can easily have hundreds of instruments in your curve framework on a per currency basis. So actually, if you want to do complementary value, finite difference approximation, that's a minimum of 100 chips on a single-sided finite difference approach. Double-sided, obviously, you have double the number of chips. Interest rate vega, just for one currency, 20 tenors and 20 maturities is not actually, some volatility services may have more tenor points than that or more maturity than that just on your swaption at the money surface, let alone any representation of skews or smiles. That's going to give you 400 chips on a single-sided basis. So actually, XVA sensitivities, potentially, if you go down the finite difference approach, there are other alternative approaches. I'll let Ignacio talk about those. It's a hugely computationally demanding. So you've either got to do something very clever, or you've either got to do it very fast. One of the two, and potentially both. Okay. So just to kind of finish off, I'm going to throw something out there which is a little bit a little bit different than the other types of things, but it's just to kind of point where the industry is going in terms of what it's looking at. So there's a lot of interest in automation and intelligent systems. Automation, and why is that? Well, actually, partly it's because we can, it's starting, systems are starting to get to, the tools that allow you to do machine learning, intelligent systems, are not what we would call artificial intelligences yet. At some point, they probably will be. But those kinds of tools allow banks to look at automation and semi-automated book management. And that's what I'm talking about here is not algo trading, which is a different field, but obviously using some of the same technology. But potentially in the future, trading desks will be making more and more use of automation, semi-automated book management because they can, because the tools allow them to do that, to automate some processes that are currently manual. It also will creep into advisory services, intelligent systems, where you can build a system which provides certain sets of advice to the more basic sets of questions that customers and clients would like to ask, and then it allows staff to focus their attentions on the more complex questions that a basic system like that couldn't do. Right? So it allows you to shift resources potentially away from the more basic to a more complex and more demanding questions. But also, there's also a lot of, there's regulatory interest in this, and one of the, there's a lot of demands for trade monitoring, which is becoming increasingly important. And these systems play a role there. So you've got, regulatory requirements, how satisfying broker, proving that whatever mitigation you adopt for an individual trading desk, making sure that that trading desk satisfies the requirements associated with desk monitoring to ensure that it does satisfy those requirements. And if it doesn't satisfy those requirements for whatever reason, that is captured and validated and understood. Things like MiFID II trade reporting. So making sure that trades and details of trades are reported on the correct timescale. Those are critical elements of regulation that are coming in, and there's a lot more, and there'll be a lot more in the future. But also compliance reasons. Compliance, again, ensuring that your trades follow the rules, comply with regulation, comply with internal requirements, making sure that the right people are doing the right trades, and the rules are being followed. That's also a requirement. So again, there's a lot of potential use for other types of tools other than the kind of pure performance ones that we spoke about in the first half in the future. So those are the kind of the three topics that are covered really, which is to talk about regulatory impact, XVA measurement, and then finally kind of automation and intelligent systems, just to kind of throw out now at the end actually the direction of travel for technology in banking and in the derivatives area. So that's the end of my part of the presentation. So I'm going to hand over to Ignacio now, and just thank you for your attention, and we'll take questions at the end. Thank you.